If you have an S corporation or are considering an S corporation, in this video, I'm going to do a walkthrough so you can understand how to split up your income between your W-2 side and your distributions. Now, the benefits of understanding this and doing it is it's going to help you maximize your retirement dollars, both on the traditional side and the Roth side. We're going to reduce your taxes. We're going to increase your QBI, which is a qualified business income deduction, also known as a Section 199A deduction, and we're going to help you reduce your adjusted gross income. What's going on, guys? Welcome back to the channel, or if this is your first time at our channel, welcome to the channel. My name is Travis Sickle. Now, before we go through this walkthrough, I want to give you this disclaimer or this disclosure. Now, this is only one example. It really is important to understand that your particular set of circumstances, your facts, are going to affect the outcome and what you should do. So if you have another job, you have another business in addition to your S corporation, it could change the facts a little bit. And if you have any questions while we're going through this, let me know in the comments down at the bottom. So let's go ahead and go through this walkthrough so you can really understand how to do all the things I said at the beginning of this video. And I'm going to bring it up on the screen so we can go through it together. I've done most of the math just to speed up the video. And again, if you have questions, let me know in the comments down at the bottom. So in the example that we're going to run today, it's somebody that is earning $300,000 from their S corporation. Now, if you're earning less or you're earning a lot more, either one is fine. It could work for you, but remember, your particular set of facts and circumstances are going to affect exactly how you should tackle this stuff. So let's go ahead and get into it, but just keep that in the back of your minds. So if we're taking a look at this example right here, this is somebody that's earning $300,000. I have two scenarios here. Here's scenario one. Our W-2 is $50,000 and our S-Corp distribution is $250,000. And in the second scenario, it's going to break down to $100,000 in W-2 and $200,000 in distributions. So let's stick with this scenario right here for just a second. So somebody that's paying themselves $50,000 will have FICA taxes. So you're going to pay in Social Security taxes $3,100 as the employee, and it's also going to be matched as the employer. And then your Medicare is going to be at $725, and that's all based on this $50,000, which works out to $3,825. And if we multiply that by 2, because we have both the employer and the employee side, that's going to work out to $7,650. And if I bring the calculator up here and we put in $50,000, multiply that by 0.153, we have our $7,650. That is the taxes that we're going to pay on our Social Security and our Medicare, also called FICA. And based on this math, if we're doing this, we're going to have 1/2 a deduction. So this is going to be a deduction that's going to come off of this $250,000. And that will work out to a federal taxable amount of $41,473. This is the tax due on this $300,000, broken down with $50,000 in W-2 and $250,000 as the S corporation. Now, here's what I want to point out. So this is what we have. If we add these two numbers up, we get $49,123. Let's make sure that math is correct. $41,473 plus our $7,650 is our $49,123. Now, what you have to understand is that for the taxes on Social Security and Medicare, our FICA, right? Those are only calculated on our W-2 wages. So the less from that side that we have on our W-2, the less in Social Security and Medicare taxes that we are going to pay. The distributions, those are only subject to our federal tax bracket. So depending on how you're filing will depend on how much you're going to pay in federal income tax. But that is how that's broken down. And we haven't added in any retirement savings whatsoever, but let's go ahead and look at the other example just so you can understand what that looks like of moving dollars from the distribution over to the W-2 side. So if we take a look at this, we have $100,000 and now $200,000. So still our $300,000 in total income. But this is obviously going to boost our Social Security and our Medicare taxes, which are going to boost to $15,300. A little bit easier to do that math based on $100,000, which is 15.3%. Now, if we calculate this out to our federal taxes, that's $43,138. And if we add those two up, it's $58,438. So significantly more than our first example, but generally speaking, our income was still $300,000 in both examples. It's just a matter of how we allocated it between our W-2 side and our distributions. So coming down here, we see quite a big difference in just making that one little change. Now I want to go through and explain what happens when we look at your retirement plans. If we start to add into your retirement plans, is there anything else that we should be aware of? Now, right now you're probably thinking, let's get as much money onto our distribution side and pay ourselves the least amount on our W-2. And ideally, that's really what you want to accomplish, but there's a couple of things you need to understand. You have to pay yourself a reasonable wage. That's IRS guidelines. Now, if you don't, they just come back and literally tax you on everything, and they say that nothing was a distribution. So you want to get this right, because the IRS, if they catch it, if they think that you're not paying yourself enough to obviously pay less in taxes, then they're going to get you. So you have to pay yourself a reasonable wage. There is no hard number that you can use in order to pay yourself a reasonable wage, but you need to document it. But we're going to save that part for a different video. Now let's jump over to the retirement side, just so I can show you with these exact same examples what it looks like if we start to make contributions into a retirement plan. So if we add in the same example, and I tried to keep it as organized as possible. Let me take it out from under here. And we have our $50,000 and our $250,000. Now, in this example, I'm going to assume a solo 401k, and we can save up to $19,500 as the employee, which comes from this side. So the $50,000, as far as the taxes go, the federal taxes go, it's reduced by $19,500. But what doesn't get reduced here is your FICA taxes. So you still pay Social Security tax and Medicare taxes, regardless if you put this money into your workplace retirement plan. So even though we're putting it into the solo 401k, we still have those taxes. But by putting it into the traditional side, we're reducing our federal taxes. So the maximum that we can match on the employer side would be not from this 250, it comes from this 250, but it's based on this 50,000 as a W-2 employee. So the most that you can put in would be 25%. So that's where we get the $12,500. And if we add those two up, that's $32,000 in pre-tax money. So this is reducing our federal taxes. And we can also do a total after-tax contribution of $25,000, bringing it to a maximum of $57,000. Now, I ran these numbers based on 2020. So for 2021, it's $58,000. But again, this is just an example so you can kind of understand how this all works. Now, the federal taxes, because we put money into a retirement plan, drops to $34,393. And if we add in our FICA taxes, that's $42,043. And our adjusted gross income is $264,175. So that has dropped quite a bit as well. Now, if we jump over to the $100,000 example and only do $200,000 in distributions, then the amount that we can put in as an employee is exactly the same. The employer side increases because our W-2 increases. So going from 50 to 100 now allows us to save double the amount as well at $25,000, and that's $44,500. Now this is pre-tax, so quite a bit more that we can put in pre-tax, and then we can close the gap by putting an additional $12,500 in after tax. Think of it like the mega backdoor Roth strategy, and you can have $57,000. So in both scenarios, we're able to get to the $57,000, but we were able to get quite a bit more on the 100,000 side pre-tax. Now, another thing to note is if you're 50 and older, you can do an additional 6,500. And in that $50,000 W-2 side example, you wouldn't be able to actually maximize your retirement plan. You would be short by $500. So something else to keep in mind while you're figuring out how much you're going to pay yourself on the W-2 side. And then if we look to the total amount of federal taxes, it's $33,658. And if we add those two up, it's still more at $48,958, but our adjusted gross income is lower at $247,850. Now, something interesting occurred is in this example where we're putting more money on the W-2 side and inevitably paying more FICA taxes, but you also increase the amount that goes towards Social Security. Now, a lot of people think that Social Security is not going to be here on down the road, so maybe you just want to discredit that. But if you do think Social Security will be there, then contributing more money into the Social Security system will mean that your benefits are going to be higher on down the road. A little bit more difficult to calculate in this type of an example, although we could run projections on your income for Social Security, but that's something to keep in mind. So even though you're paying more in taxes, the bulk of it comes from the increased amount in the Social Security taxes. Now, the other thing that we want to take a look at, or I want to point out, is the reduction in your adjusted gross income, and that comes from increasing your W-2 so you can allocate more towards the pre-tax side of your retirement plan. Now, this comes into play if you might qualify for things like certain credits, like the child tax credit. So if you can get your income lower, you're going to qualify for more, or the stimulus checks that we had last year and that third stimulus check that we had in 2021, which gets calculated on your 21 taxes. So those are the things that you want to look out for, whether or not you're going after a retirement plan for the pre-tax or the after-tax dollars. But once you get through that, you really want to get everything back on the distribution side. Again, as long as you're paying yourself a reasonable wage. If you get it too low and it triggers that IRS audit, then you're going to have a problem. But once you get to that maximum amount, so you can allocate as much as you can towards your retirement plans and you're meeting that criteria, then you want to get it over to the distribution side. Because the other thing that your distributions will have, those distributions, that will qualify you for more of the QBI. That's their Section 199A. Let me see if I can pull it up on the screen to give you an example, just so you can see it here. Now, this is an example of just some math I was going through, but let me pull up the QBI page and show you what it looks like. Now, it's going to take into consideration, so you can see here it says $233,675. Let me go back to the 1040, and you can see that the amount that's coming from our S corporation is $233,675. So it's taking that full amount that we have. The reason it's that amount, it's not $250, is because I was working out the math to take the deductions and the employer side contributions, because those are also deductions. So if we go back to here, we see that it just takes that number and multiplies it by 20%. That becomes the deduction, unless there is a reduction based on your income and whether or not you're then getting into higher incomes where there's a phase out. Again, I'm not going to go over that part in this video, but I just wanted to show you how it works. So your QBI will be higher, also the less that you pay yourself. So again, the name of the game here is to pay yourself a reasonable wage, but pay yourself enough so you can get the money into the retirement plan. But once you reach those maximums, you're maxing out your retirement plan. Also, I say maximums, and I'm showing you the math for the maximum, but if you don't want to save that amount, then you might want to allocate it a little bit differently. So they're synonymous. If I'm saying the maximum, whatever you can contribute, that's your maximum. So that's what you want to work these numbers around, not what the maximum limit is. I'm just showing you what the limits are. So once you get it there, then put it over to the distributions. It will increase that QBI and you'll be better off. But as you can see in this situation, if the only thing that you're looking at is your federal income taxes, then you might make the wrong decision. you might not allocate it correctly, because in the example, it will increase your taxes, both your FICA and your federal, if you allocate more towards the W-2. But if we were able to put that into our retirement plan and reduce our taxes, then we're reducing our adjusted gross income to qualify you for more credit. So that's something to consider. But then on the other side, if you want to put more money into the Roth side of things, then you can still keep your income low and make non-deductible contributions and take on that mega backdoor Roth strategy, which I've talked about in other videos. So it really depends. There's so many moving parts in this, but hopefully going through these types of examples will make you more confident and shed some light on exactly how you should break it up, what you can kind of think about in your particular situation. But again, there's so many different variations to this stuff that if you have another job, it can completely change the outcome on what you should do. Because remember the Social Security max that you're dealing with, once you get over those thresholds, then it might not make sense. It might not come to the same conclusion as we did in this example. So something to consider. If you have any questions on this, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.